And companies joining us now to take some questions. Mark, great to have you with us here. Thank you very much. We had a bunch of what could be construed as hindrances. Data which was strong, which in normal times is good news, but you don't want strong data. You want moderately, just about right, not too hot, not too cold data. But the ISM services number overnight was strong. We had some hawkish Fed commentary, and we had that OPEC cut. But despite all of that, I mean, equities have marched on. Absolutely flat close overnight. Do you think this bodes well for the continuation of this relief rally, Mark?
Prashant, by the way, the futures are up 0.5% as of now. So, yes, I think it does. The market had every reason to go down yesterday. It did go down, but just a little tiny bit. So we're still up about 5.3%, if memory serves me right, for October so far. I think it's telling you something. I'm not quite sure what, but it's telling you that the market is willing to look through the hawkish commentary that just a couple of weeks ago would have sent it down percentage points. And, your Bostic said 4.5% on the Fed funds by the end of this year. And Mary Daly still talking very tough. Inflation is high. We're not going to cut. But for some reason, the market's looking through that.
The market is willing to look through hawkish commentary. Is it also telling you that perhaps the worst of the bear phase across global markets is now behind us, Mark?
Yes, I think so. I mean, I wish I'd predicted this huge bear market at the beginning of this year, and I did not because I didn't realize how hawkish the Fed was going to be. In retrospect, back in January, the signals that they were doing a 180-degree turn, we should have paid far more attention to those. But now the market is down around 20% so far this year. I think we are putting in a bottom. October historically is the month where major market bottoms occur more than any other month. And even if we get a recession, I think it'll be a mild one because the labor market is still so strong. There's still 1.7 jobs available for every one unemployed person looking for work. And so 20% decline in the S&P is really about what you usually see when you have mild recessions. And so either we're going to have a mild recession or we won't have a recession, whichever it is. Yes, I think we're putting in a bottom here.
Mark, our viewers will be quite happy actually to hear what you're saying, because the worst of the bear market may be behind us. And also you're saying that the global participants are prepared to look through this hawkish Fed. You had a couple of commentators overnight, Prashant, I'm sure you tracked that closely, and they sounded rather hawkish. They said our core focus is going to be on inflation, and we're just starting off out there. So the domestic bulls out here as well will be pretty happy to hear that.
In the US, guys, the S&P is just about come back above its, it fell below June lows. I think we're right there in June lows, right? Here, the low was what, 15,200, right?
Yes.
Yeah.
And we're at 17.
10% away from there.
It's been incredible.
I think it's also because, our own corporate profitability to GDP ratio has gone up so much, right? We were discussing it. You spoke about Bajaj Finance.
Yeah.
All the business updates that came in the last 7 days have indicated that corporate profitability
chalk and
has
cheese,
improved.
absolutely.
Yeah.
All right, let's get back to that conversation with Mark. Mark, we'll get to the equity markets, but what about the other asset classes? The dollar index, well, it moved to around the 114 very briskly. It pulled back a little bit. I recall when we chatted last, we were talking about 110, 111. So what's the outlook on that one? Because that's one of the key points that, for our Indian markets. And Brent crude getting a little uncomfortable, right? At around $94 per barrel. Outlook out there.
Nigel, you're absolutely right. The dollar is key, and I was interested to see the cover this week for Bloomberg Business Week's magazine is the dollar can't stop, won't stop, and you can Google it. You'll see a big cartoon of the dollar going up and up. And there is something called the magazine cover index, which is basically a indicator that when something gets on the front page of a major magazine like that, you do the opposite because everybody already knows. So I think the dollar is actually peaking around here, not necessarily right now, but if I look back at the rolling 12-month rate of change in the dollar over the last 50 years, only 3 times did it exceed the 20% level that it's at currently, which were in 1985, a few months before the Plaza Accord, and again, the global financial crisis, and then when China devalued the renminbi in 2015. And my point would be that, yes, in those times, it did go higher on a 12-month rolling basis. It did get as high as, I think, about 25%. But in all 3 instances, it then fell very quickly thereafter. And I can't really say what it might be that causes the dollar to go down this time. But my hunch is that history doesn't repeat itself, but it does rhyme, and it will be going down in the months ahead. As for the oil price, $100 a barrel is possible given the production cuts from OPEC last night, and certainly makes one less confident about headline inflation going down, because the major reason for the headline inflation going down was the oil price.
Mark, the other one is China, right? Which many are. Middle of this month, we've got that big conference in China. And if there is significant policy change, and I don't know who, Morgan Stanley or one of the other sell-side research houses said, if China changes its reopening, changes its zero COVID policy even a little bit, I mean, oil would be in serious short supply. I think we heard that from OPEC as well. So from an Indian market perspective, oil is critical, crucial. Any thoughts, Mark?
Firstly, I don't think if they open a little bit, that will mean the oil price goes up. They'd have to open a lot. And I do not think they will open a lot. It's anybody's guess. But I think that, the bond market will tell us, because when bond yields in China start rising, that'll be a signal that better times are coming for the economy, or maybe stimulus is coming. And they're simply not going up. Maybe that's because nobody knows yet what's going to come out of the party Congress, but and nobody does actually. So I think we just have to wait and see. But if I had to choose between opening up or not, I would say not, and maybe just gradually lifting the zero COVID bit by bit, and that won't be enough to stimulate the oil price a lot, in my opinion.
Okay. In India itself, Mark, the big trade in the last 6 months at least was to go short on IT and long on financials, and that worked out very well. You think that could be the order of the next few months too, or could tables turn?
I'm sorry, I better not attempt to answer that question, Sonia, because I haven't been paying enough attention to the sectors in India. Apologize for that.
All right. So, let me just flip that question around, right? I mean, financials globally and in India have done pretty well. And IT, because perhaps of the impending recession in the US, there's some struggles over there. Perhaps client spends could go down. Do you think a lot of that is in the price already? Maybe not for India, but even for the global markets?
I do think that a lot of IT, but certainly not all of it, is what one can call quality growth. And you do have to screen, because companies are all different. But a lot of these companies have, they're leaders in their sectors. They have strong cash flows, and they're good companies. So I would say I would prefer to answer the question by saying that I think whether we're in a bear market, which I don't think we are, I think we're at the tail end of a cyclical bear market, or we're in a structural bear market, which will last longer, I would still want to own quality growth. I think it'll outperform in either environment. In the bear market, in the tail end of the bear market, simply because those companies have derated a lot, they came down more than the market, and in a structural bear market, because I think it means that interest rates will eventually have to come down, and they tend to like that.
All right, Mark, final question before we let you go then. What about India among the emerging market pack? We're pretty happy. We've decoupled from what's going on. We're flattish for the year. But see a market like the Brazilian index, that's outperformed actually in dollar terms. What's the pecking order from this emerging market basket? There's Indonesia in there, India, Brazil. Your take on it?
The emerging markets that have been fairly have uncorrelated economies, and India is one and Indonesia is another, and are kind of proxies for, well, I'll take that back. Anyway, the uncorrelated ones with big domestic populations, India, Brazil, Indonesia, they have outperformed this year. And there is a lot of now speculation that the time is to sell those and shift into the kind of global growth ones that have underperformed, like a Taiwan or a Korea. And I can see both sides of the coin, but I would simply say that our long-term bet is on India. And even if it underperforms, say, a Korea or a Hong Kong over the next 6 months, because they have so much more catch-up to do, because they fell a lot and their currencies fell a lot more this year, the Korean one at least. I would, India is our big bet for 5 years, not just for 6 months. And so we want to stick with it.
Okay, that's, I guess, our headline for the day, right? India is our big bet for the next 5 years and not just the next 6 months. The viewers and investors would be pleased to hear that. Music to our ears. Thanks a lot, Mark, for joining in, and have a great one. That's Mark Matthews of Bank Julius Baer. Let's slip into a quick break on that note. On the other side, our entire research team will be with us and help us with the top 10 stocks. Stay tuned.